2-1, declining to advancing stocks. China down 3%, but they've been closed for a week, remember. Europe down about 1%. Take a look at the sectors, and it's decidedly defensive, no surprise. It was similar to this on Friday. Utilities, which interestingly did fairly well last week. Some say that's a sign that people don't think rates are going to continue to go up that much. Staples, REITs, healthcare, those are your four defensive sectors. They're the ones that are leading, at least on the upside. Energy's down today. That's been a big market leader. But remember, we went from, 73 to 77 on oil, and now we're back down towards 73. So no surprise, a little bit of profit taking in energy. Rates are the big issue. Of course, home builders are down again. But we've emphasized this all last week. Rate-sensitive sectors like emerging markets, EEM 52-week lows, building stocks generally at 52-week lows, and a lot of the companies associated with them like Mohawk and Whirlpool 52-week lows. Autos generally are hovering around 52-week lows. And I mentioned last week, gaming and casino stocks were also down and have been down, trending now for the last couple of months. The ETF associated with that also new lows. Those are very heavy leveraged groups here, casinos, and certainly would be affected by rising interest rates overall. I think the important thing about right now is we're looking at a macro backdrop that's rather extraordinary, and that's why a lot of people feel we can withstand rising rates, at least gradually rising rates, and not necessarily move down in the stock market. We don't see periods where we have record earnings, 20% more growth in earnings 3 months in a row, 3% GDP growth, the lowest unemployment in 50 years, consumer confidence near a record, and a very low probability of recession. Those are not ordinary, the economy is slowly getting better. These are rather extraordinary macro environments. So little wonder when you see these kinds of environments, rates don't necessarily kill the stock market. We did a study earlier in the year with Kensho that looked at the 5 periods in the last 25 years when we have seen big moves up in the 10-year yield, something like we've seen here. And the period generally does very well. 5 of the 6 times we are up an average of 23% during periods of rapidly rising rates. Now, obviously, if the economy heads south, that's a different story, but these are not necessarily associated with declining economies. And what sectors were up? Well, it's not surprising. Technology, growth sectors tend to do better. Consumer discretionary, not surprising. Economy's strong. Consumers have more money to spend. That's not surprising. And financials, when you get a steepening yield curve, also tend to do a little bit better during these rising rate periods. So it doesn't necessarily mean everything goes up, but it also doesn't mean things are bad. I want to point out that we have been very lucky here in that we've had a tremendous amount of rotation this year. So while financials haven't necessarily done that greatly because we haven't had a yield curve move up, we've benefited from other sectors. So healthcare has been just a monster this year. We have been moving steadily up, 12, 14% since July in healthcare. There's that slope up for healthcare stocks. We've also seen energy, as I mentioned, the breakout in energy going into the high 70s, which had done nothing for most of the year. That's helped a little bit as well. And the industrials, as we have gotten less concerned about the China trade and tariff trade ruining international industrial stocks, you can see since July, and again, this is when it's gotten better, industrial stocks have moved to the upside here. That's why the S&P has held up so much, so well. That's why we're only down 1% this month. The S&P itself is only 2% off of its historic highs, and it was only a few weeks ago. We've had all these concerns about rate hikes, and we've had a little bit of a shock last week because the pace moved up faster than expected, and people got agita. But keep your eyes focused on the macro environment, and I think you'll find that there are a lot of reasons still to be very optimistic about whether or not we're still going to move up and move higher towards the end of the year.